We continue with our discussion on financial management under Unit 1, Introduction to Finance. In this particular video, we are going to discuss the concepts of compounding and annuities and perpetuities, which are specific kind of cash flows, and how they kind of impact decision making, what are the kind of various formulae that we need to learn, and what are the concepts that we'll need to learn. We'll also try a few problems along with this now, because this is now getting into a little bit quantitative aspects, and the idea being that because these formulae are used again and again, we should have a fair sense of how do we calculate these, both conceptually as well as using Excel. The first concept that comes to our mind is the concept of compounding. We have already seen the concept around compound interest. Compounding essentially means that you're earning interest on interest, right? So this is a scenario where you're earning interest on interest. So the concept stays like this, that a lot of the times the interest is paid on instruments at a frequency which is more than once a year. You can deposit 100 rupees in a bank and the payment could be at, let's say, a 12% interest, but it may not be annual. It may be semi-annual, it may be quarterly, it may be monthly, right? For example, a bank that offers monthly interest rates that can get compounded 12 times a year. The interest you get in the first month gets added, and then in the second month you have the entire amount on which you get the interest. In the third month you have this entire amount on which you get the interest, and so on and so forth. So what happens is you will know that effectively the final return will get increased, because now on every month's interest you are getting some more interest, right? However, remember that rather than, even if they are giving a monthly interest, rather than quoting the monthly rate, institutions like banks and other financial institutions quote the annual rate. This is known as the stated annual interest rate, or quoted interest rate, or just stated interest rate, right? When you are saying 12%, this 12% is in annual terms, right? Now, suppose a bank compounds interest on a monthly basis. What does that mean? Every month you take your stated interest, that is stated interest rate, and divide it by the number of periods that the interest will be paid for during the year. In this case, if it is being paid monthly, the number of periods is 12, which means every month you are being paid 1%. Correct? Now, if this was a simple interest component, every month you will make 1 plus 1 plus 1 plus 1, 12 times, that will give you 12, right? 12 times, that will give you 12. But this is, remember, compound interest. So how does compounding work? Suppose the bank gives 12% interest rate as its stated annual interest rate. It compounds monthly, which means every month you will generate interest. In the first month, your 100 gets 1. So that becomes 101. In the second month, 101 generates an income of 1.01, right? In the third month, you get an income of 1.02, 1.03, 1.04, and so on and so forth. Why is that? Is because in the second month, your interest is being calculated not on 100, but on 101. In the third month, the interest adds 100 plus 1 plus 101, and the third month interest is calculated on this entire amount. The fourth month interest is calculated on this entire amount. The fifth month interest is calculated on this entire amount. Now you note that by the end of the period, you have in the 6, 7, 8, 9, 10, 11, and 12th month 112.68 minus 100 divided by 100. That's your return, right? So that will be 12.68%. Correct? Now note that the bank had given a quoted interest rate of 12%, but effectively you made 12.68%, right? So while the quoted interest rate is 12%, effective interest rate for you is 12.68%, and that is the power of compounding, right? To understand this better, we can also look at another example and try and gauge this a little bit better. Before we go there, let's try and formally introduce a formula around this, right? So what it says is that effective interest rate is 12.68%, higher than the stated annual interest rate. Note that the interest is compounded more than once during the year. Then effective interest rate will always be higher than the stated interest rate, because the stated